The RBA governor says that inflation is heading to 7%, but he doesn't see a recession coming. Is he right? And after a big sell-off, are banks now in a buy zone? And with just 8 days to go, I'm excited. Actually, I think it's only 7. 2 end-of-year tax tips. I'm Paul Rickard. No Peter Switzer this morning. Hopefully you're back next week. And I'm mad about money. Well, the RBA governor's been out meeting the press, doing interviews, telling us to make sure that wages don't go up more than 3.5%. But the most interesting thing he said yesterday was, despite all the talk about how, around the world about global recession and the rest of it, he doesn't see a recession coming for Australia. He maintained the Australian economy is pretty strong, pretty resilient, lots of spending, full employment, highest participation rate in 25 years, and that's going to stop us from going into recession. Let's hope he's right. I believe he is. Only time will tell, but there is just so much recession talk, particularly coming out of the US. It's hard to just remember just how good times are for many, many Australians. And remember, you just can't find labour at the moment, so we're a long way from having an issue with unemployment, which really leads to people having a lot of consumer distress and other problems. So I don't think a recession is coming. Like everything in markets, we always like to predict stuff, but sometimes cooler heads prevail. So let's hope Dr. Lowe gets this one right. Now, that leads on to the question about banks, because a big sell-off over the last week and a half, I guess for 2 reasons. One is the market suddenly remembered that higher interest rates, while they're good for bank profits in the short term because they make more on their net interest margin, in the long term, higher interest rates potentially mean that consumers and people who have mortgages and businesses pay a lot more interest, can't service their debt, and eventually, if they go too high, then we get it into bad debt territory. That's exactly what's happened previously when interest rates have been raised before. And for some reason, the market kept saying, okay, interest rates going up, that's going to be really good for banks. Well, I wasn't one. I always said at some stage they're going to worry about the impact on bad debts. Now, all of a sudden, the market suddenly realised this last week, and that's what led to the sell-off. But I think you've got to put this in context. One, first of all, the banks are actually still have net negative bad debts. Look at their last set of results. They're actually still being able to, they've got provisions they set aside in COVID they haven't fully utilised up. So there are no bad debt issues, problems with the banks at the moment. Secondly, interest rates are going to have to go a long way. And we know that from all the data, people with mortgages in particular are way ahead of their repayments. So it's going to have to be a huge increase in interest rates to do it. And thirdly, there are going to be some bumper profits in the short term. So my sense is the market's a little bit overdone on the bank side. Now, because of the lead that's coming out of the United States, that market clearly in trading like a bear market despite the rally last night, if the market wants to sell off, they're going to sell off the banks. So I think you've got time on your sides. But when you see stocks like Westpac under $20, I think that looks interesting. NAB is probably still my pick of the banks, and that's the one I'd be going for. But I think you've got time on your side. You can afford to wait for the down days, because in the down days they'll sell off the banks. But there's going to be some good buying the banks. Finally, 22nd of June, I think it is, so it's 8 days to go. Just 8 days to the end of the financial year, so don't forget about that. This is a time to really focus on a couple of last-minute things. So with 8 days to go, what are the things you can do? Well, the first of all is to make sure you get your tax return in as soon as you can, because for a couple of reasons. One is a lot of taxpayers are going to get going to get the tax offset, which carries through. So you don't get, when you put your tax return in, you get the money back from the government. So this is one of those special sort of cost of living measures that was introduced. It carries over. Secondly, for investors, we've seen a lot of franked dividends last year. We've had 3 or 4 major off-market share buybacks. The sooner you're getting your tax return for your super fund or whatever it is, the sooner you get the cash back from the government. So first of all, action. Work on your tax return, and you can effectively do that as soon as you can, as soon as you get your statements from your investments. Second thing is that this is the last year of the sort of COVID relief, which introduced a test for those working from home, and basically said if you work from home during the year, you don't need any receipts or other things in terms of being able to claim working from home expenses. They've introduced a special shortcut measure, 80 cents per hour for every hour worked at home during the last 12 years. No records needed, just some sort of representative diary about the time you spent at home. So if you've been working at home, maybe a couple of days during the pandemic, just don't forget to get the claim in, 80 cents per hour, and you can get that back from the tax office, no questions asked. But anyhow, third tip, please remember our charities. This is the time to dig deep and help out a lot less fortunate people than us, and let the government kick in and subsidise it with the tax deduction. I'm Paul Rickard, and I'm mad about money.